There are people who want to make money in the stock market without having to do anything. They just want to put the money in the market without doing any technical analysis or following any fundamentals of any company, but they want to earn dividends. Now, that is why we are here today, to show you 6 ways you can make money from the financial market without having to pick any company to invest in. Welcome to Clockwise. My name is Providence, and as I do it here every time, I have my guest, somebody that has turned to an in-house guest, and he's here to do the analysis for us. Now, with a resounding virtual round of applause, welcome, Mr. Kenneth. Welcome to Clockwise.
Thank you very much for having me.
Today we'll be discussing mutual funds.
Okay.
Yes, mutual funds. A lot of people think that investing in the stock market only entails you buying stocks or investing in a particular company or a particular name. But there are other ways people make money from the stock market, even without having to do anything so special, without doing analysis by themselves, without doing research by themselves, only just researching on this particular thing we're discussing today. So we're discussing 6 mutual funds that are paying dividends. They've been paying dividends, and they are still paying dividends. So first of all, before we dive deep into that conversation, let's have an overview of what mutual funds are and how they work.
Okay, thank you very much. So, first of all, for mutual funds, a mutual fund is actually a fund where you have, that's why it's called mutual. People contribute to the fund, and then the fund manager takes what's been contributed and invests it. So they can invest it in equities. That's what we call equity mutual fund.
Okay.
You could invest it in bonds. That's what we call fixed income mutual funds. You could invest it in both of them.
Okay.
That's what we call hybrid. So that means part fixed income and part equity. What I mean by fixed income, like bonds.
Okay.
Yes. So that's what we call mutual funds. And after a while, periodically, whatever profit he makes, based on some agreed formula, he distributes. That's why it's not called dividend, it's called distribution.
Yeah.
So he distributes the earnings based
You
on
use dividends so that people actually understand.
No, if you use dividend, that means you have. Let me tell you why you don't use dividend, because dividend is associated with what you earn from stocks.
Yeah.
But because mutual funds don't only do stocks, they do dividends. Mutual funds earn from dividends as well as other means. So that's why it's not exactly correct for you to say dividends. So that's why I use the word distribution. And I want anybody that's listening to this or watching this video to know that for whether it's ETF, whether it's mutual funds, most of these funds, what they do is what we call distribution, not dividend. So when the fund manager earns, he then distributes what he has earned to people with respect to how much you brought in. So for example, if your contribution to the mutual fund is, let's say, 10%, then the fund manager makes 100 million naira, then what you're entitled to, it makes 100 million naira. And then the sharing formula is he keeps 20%, because that is there's usually that 2-20 principle. So he keeps 20%. That means 80 million is available to be shared among the investors. So for that, if you had 10% of the mutual fund, you are going to get 8 million naira. That's how a mutual fund works. Okay. Simple. So those distributions are what are being paid, sometimes monthly, sometimes quarterly. So depending on the mutual fund that you subscribe to, you need to know how often distributions are made to.
What you're trying to say is that the heavy duty has been lifted up from.
Yes. So the bulk of the work, the heavy lifting, is done by the fund manager. The fund manager has to be very, very sophisticated.
So you just make yours to make your fund available.
Yes, and there's a difference. There's difference between mutual funds and hedge funds, because I know that the moment I mentioned that 220, people will think, and we have done a video before about hedge funds. So the difference between mutual funds and hedge funds, in the case of mutual funds invest in regulated securities.
Okay.
So that is because most of these mutual funds actually work with pensions, with funds that you cannot afford to lose, really. So they actually go after very regulated securities. That's number one. Number two, some of them have lower fees than the traditional hedge fund. Okay. The traditional hedge fund is 220. And here is also another point. For a hedge fund, whether the fund makes money or it doesn't make money, the 2% is taken out. The fund manager takes out, the hedge fund manager takes out his 2%. So for example, let's say you invested in 100 million naira. Then and then the fund, maybe, of course, the manager takes out his 2 million immediately. Then 98 million is left. Yeah. Then the next year, even if that fund loses, let's say 10 million, and it's now back to maybe 88 million, the manager will take his 2% again. As far as that fund exists, the manager keeps on taking his 2% every year. So, but the only thing is that for performance fee, which is the 2020, the performance fee, the manager does not. He has to get above the hurdle rate. In which case, the hurdle rate could be like 100 million, because that's what you started with. So if you make 10 million, if the next year, let's say you went down to 88 million because you had a loss of 10 million, and then the next year you made 20 million, you have just made, that is like 108 million. So you have literally just made 8 million above the hurdle rate. So that means your performance fee of 20% will be calculated based on 8 million that you've made, not the 20 million that you've made. So that's the difference between.
Let's look at some mutual funds that have actually did a lot of distributions in the cost of, should I say, last year to this year.
Yes.
So let's look at them one after the other.
So the mutual funds, there are not a lot of mutual funds actually available, but the ones that we focus on are the ones that have what we call large net asset value. Yes. There are so many mutual funds that performed very well last year. But, I mean, if you have a mutual fund that the net asset value is just 70 million, I mean, it's easy for you to make multiples from 70 million because, I mean, if I make, for example, 7 million, it has actually raised the funds by 10%. Okay. But someone that has 100 billion, 7 million can't even make a dent. So we are looking at some of those funds that, number one, are stable, number two, are predictable in terms of distribution, and number three, have large net asset value. So the first one we're going to mention here is ARM as money market fund. Okay. When it comes to being very frontline, very popular, and very stable, we have ARM mutual money market fund. It's managed by, I mean, for those of us who have pension program, you are very familiar with ARM pension. So the ARM investment managers, they actually have the ARM pension, they have the ARM money market fund. So that allows them to invest in some securities, in some assets, and then distribute those to people, the participants. We have people that we call limited partners, people that bring funds bring money into invest in the funds. Okay. Then the managing partner is the one that actually does the management itself. Now, they actually pay periodically. So you could be looking at getting sometimes monthly, but you are very sure of periodic
and they've been consistent in it.
And they've been consistent. So for those people that are chasing, and one thing that is also good about them is that they also they don't just focus on distributions, but they ensure that asset appreciation is also very on the front burner. So you might want to consider ARM, money market fund. That's the first one that we have. Then there's another one that is quite popular among a lot of people. I mean, if you ask 10 people that are in Stanbic, that means possibly you are also part of. So you realize that a lot of people are doing. Everybody, my teacher called me. He's a man that I respect so much. In fact, if there are 3 people I respect, he should be number 1. He called me and told me about, and I asked him, "Sir, which are you doing? You said Stanbic. So
Stanbic. I think Stanbic has done a lot when it comes to publicity.
Yes, Stanbic has done a lot. You know, when you are a bank and then you also have these funds, you are at an advantage because you can actually get it across to your customers.
Yeah.
So that is what is making it. In fact, it's one of the largest, actually, one of the largest in terms of net asset value.
Okay.
And there's something about net asset value. Net asset value means that the fund can be very resilient and has more to invest. There are some assets that you need. There's a threshold that you cannot invest if you have something below that particular threshold, especially like things like private markets are not available to people that have $1,000 or $2,000. No, there's a that threshold. So the more the fund has, the more the net asset value of the fund, the more assets it could invest in. Some of these insane returns that you see don't happen in listed products or listed assets or listed stocks. Okay. They happen in the private markets. So, but that private market is also closed to some people, especially if you don't have what is above the required threshold to be able to access those funds in terms of your net asset value. So when you have a Stanbic IBTC having that large net asset value, it's a plus to them. And so they do a lot regular distributions, also. So for those people that invest in Stanbic IBTC, it's a frontline. It's a frontline money market fund that you might want to consider. Sure. They did last year more over 19% return on investment. I know that when I said that, people say, it's barely above inflation. But the thing is that, remember, money market funds, you just don't want the money to sit down and be eaten alive by inflation. So, but it's also low risk. Like, we have spent time on this channel talking about investment in equities. That's why we just decided to do mutual funds, so that if you're this kind of person that doesn't want to take a lot of risk, you could just pack your money in mutual funds and you make some money. Then the next one is FBN Quest. Asset management, of course. By FBN, you should know that's First Bank. So First Bank has that FBN money market fund. So again, the power of being a bank and having this product, because what the advantage it gives to you is that you are able to pass this across to your customers, get your customers to really come in. And there was a time I was considering this FBN because they kept on sending me messages and all of that. But I mean, I had to lean towards one of the names I mentioned here, but I'm not going to say exactly the name, of course. So they distribute. They have very consistent distribution monthly, and it's stable, very stable. The net asset value is good, so that allows them to be able to invest in, like I said, some of these funds and then they can even get into some funds, some assets long before they are listed. And by the time, because the fact is that most of the assets that you see here, like this Dangote listing, by the time Dangote is getting to the public, it has already done 100x for some of the initial investors. Okay. So these funds are able to assess this particular markets long before they are listed. And so that's where the alpha is. So FBN money market fund is what you can also look at. Then the other one is one that I think one of the commentators mentioned, Meristem.
Yeah, Meristem, yes.
Meristem, I like Meristem because Meristem, for starters, this net asset value is over 100 billion naira. So it's something that you can actually. I don't work with. Someone referred me to a name I'm not going to mention with 70 million in asset value. 70 million naira.
No.
And that particular fund made 24% last year. And he told me, can you imagine? These guys are made 24%, and the Meristem that you're even talking about made 18%. That is 6%. Yes, it's true. But I mean, you want to work with
the
big guys. People that already have a very strong base. That's why you see banks were doing very well, because now over 500 billion. I mean, is it not 20 years ago, banks were required to just have 25 billion. Now over 500 billion. You can see where we are going to. So the stronger and the larger the asset base, the net asset value
the safer self.
The safer.
The safer.
Because the other one can
they are close tomorrow. We're not saying they're going to close.
No, we're not saying they're going to close.
They can.
But the likelihood of them closing
is
higher than the guys that are sitting on
so
billions in terms of net asset value. Then there's another one that is actually even tailored to retail investors, the United Capital. United Capital.
Is it related to United UBA?
Whenever because I said FBN.
Is that related to UBA?
Because I said FBN, you said.
No, I want just asking a random question where somebody.
United Capital Asset Management.
People are afraid of anything in UBA.
I'm not going to sit here and have you discredit the bank.
No, that's not
because what you don't know is actually last week I think 3 times I bought UBA.
Okay.
I bought the stock. And people don't want to touch UBA because not just UBA, people don't want to touch UBA, they don't want to touch Access Bank. But here's the deal. I loaded up on those banks last week.
Okay, what will happen is that you will be getting information from you. So as they are doing now, you'll be telling us, okay, this is what you mean.
Yeah, of course we'll have we had already announced a Telegram channel where people will be able to have that information there. But United Capital Asset Management, it is actually for retail investors because what we mean by that is the threshold for entries is lower.
Okay.
That allows retail investors to be able to have access. It's been performing well. It sits on a good net asset value, and also because again we are talking. Most of the people we are talking about here. I remember someone said every time you keep on saying. You keep on saying if you invest $10,000, how many Nigerians have? The reality is you can scale down accordingly. When I say $10,000, I mean because we are appealing to a number of people, and then
everybody can actually understand.
So everybody can
when we say dollars,
when we say dollars, because people outside the country. I have a bunch of people that actually watch this video outside the country. So they actually do regular distributions. They do monthly. They do quarterly distributions. You can be sure that you're going to have that liquidity coming in on a regular basis. Because the thing is, some people really put in this because they want something. Someone told me, I met someone, he's a bank manager, and I can't mention the name of the bank. But he told me, he's a regional manager of a bank. He told me if I have 10 billion, and I put into a fund that can give, if he said 5 billion, that I put into a fund that can give me, even if it's just 10% per year, that's about 500 million. I don't know what I will be doing working here. So some people just want something to, they just want to live up. Because most of the people that would go for these mutual funds are people that are in their 50s. I don't think I have met any young person. I don't know. But I've not met any young person in his 30s or 20s that is considering mutual funds. I've not. They might be there. They might be there, but nobody talks about it. If they are there, then they will be looking at equity mutual funds.
But people talk about their investments. People hardly talk about their investments.
That's true though. But because if you can have opportunity to do equity and you're a young person, this is the advice I give to young people especially. I say you have time to recover. If you are, even when I'm when people structure their portfolios, for people that are in their 50s, we begin to lean more towards fixed income than equities. But if you're in your 20s, I don't know what you're doing with bonds, except even if you are trying to be defensive, which it's possible, it's true, it's necessary. But even if the market corrects by 10-20%, historically, the next bull market always gets above the previous top. So if you're in your 20s, you have at least 30 years. The market, in the S&P 500, from its low of, I'm sorry, I'm using the S&P 500 because it's something that anybody around the world can relate. From its low in October of 2022, this is less than 4 years, it has more than doubled. The low was 3,200. As I speak with you, the S&P 500 is 7,500 and something. So that means that even if you bought the top was 4,800. Even if you bought the top, you can still you would have recovered. It's almost by 4,800. That means by 9,600 you would have doubled your money, which is going to happen anytime, maybe this next year or the year after. Which means that as a young person, you should lean towards equities more than fixed income. Except you just want to have something. If you are scared, why don't you do equities that pay dividends? Because you're still going to have access to some kind of dividends, money coming in, and then you have capital appreciation in terms of the equity value of your investments. Think about someone that invested in Nvidia and someone that decided to invest in Johnson & Johnson. They are worlds apart.
It's true. All right, now the fifth one.
So you have talked about United Capital, and then of course the last one will be First Asset Management. They have the First Asset Money Market Fund. It's also a very strong and robust fund that you can consider. Most especially, they pay quarterly, but in their own case, they have it fixed. You can be very certain that every quarter you get there, it's explicit. You are getting your distribution. So that actually, for those that want absolutely predictable income source, regular income, just like you get your after quarterly earnings, most companies do dividends payout. So you can be sure if you are doing First Assets, then you are very certain that you are going to have your quarterly distribution paid to you. But you also have to understand that most of these funds, especially those that have very high net asset value, the return might be lower. There are some that can't even beat inflation. That's just a reality. But again, you have something regular. That's why I said we always say on this channel, don't lean completely towards mutual funds. I have a friend. I have talked to her. She is not leaning. She is only doing mutual funds because she doesn't want to take risk. But like they say, risk is the currency of the gods. Scared money doesn't make any money. And she makes, every year she gets 16%. Inflation is already over 16%, 16.9%. Okay, so you want to do a blended approach. You have equities, you have fixed income,
stocks,
and equity is stock actually. So you have fixed income, which is bonds and all of that. You want to lean towards diversify your portfolio, not just diversify the asset itself, but diversify the sectors the way you lean in, and also diversify even the economies that you have.
That's why we have to bring this so that you actually balance your portfolio. You don't just lean towards buying stocks only. You should also have other things, defensives, and the rest of it. It actually makes you a stronger investor. I think that the knowledge we have now can keep you safe. That when people say, I bought stock many years ago and the stock crashed. You know this kind of thing where you still talk about stocks. But you see, this knowledge will help you balance your portfolio. You can actually still follow the market and know what.
And don't be over concentrated on any stock. Yes, I know people that have already sold everything to do Dangote. You just want to invest in one stock in the entire market. We have that we have over 180.
Even SpaceX. Someone to even buy SpaceX.
Yeah, I mean, somebody wants to buy SpaceX, and that's a conversation for another day because that's $1.75 trillion. We are still kind of scratching our head because we are trying to see what value, because SpaceX
because a stock like that, for instance, now cannot give you 5x.
Do you know what it means already? At that one point, given their earnings last year, at that 1.75 trillion, that's already an 80x on their revenue. That's 80 times earnings. So the justification is what we are talking about. But again, When you think about the fact that Tesla is already trading at nearly 300 times earnings, then you know why.
We're going to discuss
it's
that.
It's an Elon Musk effect.
We'll discuss that some other day. Are you through with it 6?
Yeah, we'll talk about this.
All right, now, before we go, let's actually do this one. I know somebody's asking, how do I get into this? What are the criteria and the rest of it? So let's rush towards it.
Okay, so a lot of apps actually allow you to.
Why I keep asking this question? Because I keep seeing the question in the comments section.
Yes, but you can actually reach out to your stockbroker. It is very simple. You can reach out to your stockbroker. Like if you are for example the Stanbic IBTC, if you bank with Stanbic IBTC, it's already you can actually get across to them and they will help you.
If you want First Bank, you go to First Bank.
And then there are some of these loan apps that do the same thing. Although some of them even have their own fund, so it's almost like a conflict of interest. But they allow you to also invest in some of these fixed.
Meristem, all of them.
Yeah, Meristem even has a
They have an app
that you can actually that allows you to do that.
All right. Now, those are the 6 mutual funds we're looking at. And I think we've done justice to this conversation. Thank you for coming again.
You're welcome.
All right. Thank you very much. Now, on that note, we'll come to the end of today's episode of Clockwise. Now, do not forget to like, subscribe, and also put notification bell on this channel because of the amazing contents we bring. And also, do not forget that the elite of 21st century are not those who did not go to school or those who will not go to school, but are those who have refused to evolve as the environment is evolving. My name is Providence. I'll see you again.